Hey everybody, Frank Finance here. Hope you're having a wonderful day. Today we're going to be talking about Warner Bros. Discovery, which is a new spinoff between AT&T and Discovery. Today they started trading. Let's go through their discounted free cash flow model and see what their true value is worth according to my model. All right, jumping into Warner Bros. Discovery's discounted free cash flow model, let's go over the inputs and some of the assumptions we made for Discovery and Warner Media. Now, I did break this out between Discovery and Warner Media to combine them into Warner Bros. Discovery because we kind of need to start off with what they were doing before to kind of combine them because, again, we don't have an earnings release to go off of, and there's some things that we need to go over. I'm going to share some assumptions that have been made that aren't necessarily out there and readily available, and so I would use those with things with caution, but I am fairly confident on the numbers. I will point those things out. For example, shares outstanding and net debt are not, I would say 100% accurate, but they're as close as I could with the public information that I had. So first off, going into the growth rates for Discovery and Warner Media, I feel like kept those fairly conservative based off of where they're projected or where they were projected in terms of relative to what they were being guided at for prior to the spinoff. So if we keep their cash flows consistent, if we grow their revenue consistently prior to what they were, like separately, so Discovery continues to grow at 8%, 6% over the next 5 years, they could grow their revenue up to $16 billion. And if Warner Media by itself, that AT&T was guiding for about 6% growth this coming year in 2022, then that would give them, and dropping that off to 5% over the next 5 years, will grow them out to $46 billion with a combined revenue of $62.8 billion. Now, EBITDA-wise, that combines, I did the very same exact stuff, but with their EBITDA and free cash flow, that brings their EBITDA to $15.15 billion and their total free cash flow over the next few years to $10.7 billion. Now, those are some important factors. Obviously, the free cash flow weighs heavily on this DCF calculation of 28. Other good assumptions here to note are the discount rate. We use 10%. You could use something higher, and that's going to give you a lower DCF here. You could use something lower, and that'll also give you a higher. But I think 10 is a very medium road for it. I think debt will be a little bit. I think relatively raising capital will be a little bit more expensive for Warner Bros. Discovery than it previously was for AT&T by itself, where Warner Media was. But comparatively for Discovery, it'd probably be a little bit relatively cheaper for them. So it just depends on which side you're coming from, whether or not debt is cheaper. Obviously, across the board now, debt is getting more expensive, so this discount rate, you could argue, should be around 12%, 12.5% maybe. If you like this type of content and want to see more, please consider subscribing. Also hit that like button. It tells me I'm doing a good job. Now back to your content. Now, other thing is long-term growth rate. I have that 3%. I think that is a conservative amount. If you do raise this, obviously it's going to increase your DCF calculation here. So currently I do have them at $20.85. Other things that you should note is that they do have a net debt of 60, relative to this, what I'm calculating is about $60 billion. Now, where did I get that? Discovery had about $3.5 billion of long-term debt prior to the merger. Long-term debt, I'm calculating from the merger, about $43 billion from the acquisition. It's not really an acquisition, spinoff and merger. And then another part of that debt coming from AT&T was about another $20 billion is what I'm calculating. I could be off on that. We do know that they are paying about $43 billion for it, but Warner Media is coming across also with debt. So that is kind of how I'm adjusting for that. So that does play a big factor it does play a pretty big role, how much debt they have on their books, because you subtract that out from your enterprise value and then you divide that by shares outstanding. So that brings me over to shares outstanding for Warner Bros. Discovery. So going through the only article I could find that had it was for the current shares outstanding, AT&T shareholders on the total were being issued 1.7 billion shares. We know that AT&T shareholders were getting 71% of the company. So doing some math, obviously you can get the total number of shares outstanding. And I got that to $2.394 billion shares outstanding. So that means the DISCA shareholders would have 694 million. Now, so those are the inputs I think that really are important from the DCF perspective. From an EBITDA multiple perspective, we're looking at 12 is kind of what I have them at, and that puts them at a value of $19.67. Now, I do want to just call out here that the free cash flow for Warner before the merger was about $6 billion a year. Free cash flow, sorry, I'm getting a little distracted here. EBITDA for Warner before was 7.895. You will note that if you're doing an EBITDA multiple for how much Discovery is basically paying for it in the spinoff, it's roughly like five times. And so because you get about 43 divided by 8, you get about 5 times, a little more than 5 times EBITDA is what they paid for it. So again, you got to remember that they are also bringing on that debt. So let's say you offload another 20 billion from that, it lowers it even further. So just think about that in terms of how much they paid for it. I think it just seems really cheap from an EBITDA multiple perspective. So just keep that in mind that they did really, they only paid like about 5 times EBITDA on getting Warner Media from AT&T. And so, it just seems really cheap. And so the EBITDA multiple 12 based off of that is pretty high. So you could argue either way. However, just based off of this recent deal, the one that they were a part of, 12 would be high in my opinion. So you could lower that to 10, and that also, that lowers that quite considerably to 12. Again, the big thing here that's changing this is this present value is $107 billion, and then you have to subtract your net debt. And so that only gives you like enterprise value of about $40 billion divided by the shares outstanding. And that gives you your EBITDA multiple value per share. I got some other things in here at the bottom, how many shares were outstanding, and my assumptions on the net debt. But that's about it for today. Let me know what you think down below of this analysis of Warner Bros. Discovery. If you like this type of content, please consider subscribing. Do videos on personal finance, investing, and stock analysis, such as this one. If you like this type of content, again, please consider subscribing. Thank you so much for watching. My name is Frank Finance, out.